Hello everyone and welcome to the first video in the financial reporting module of CPA. So we'll be going through module 1, which is number 1, the role and importance of financial reporting. So what is financial reporting? Well, the purpose of this is to provide users with information to enable them to achieve effective decision making. It also provides a stewardship or accountability role by requiring managers to give an account of how they've used resources provided by those users, which is particularly important when there's a separation between ownership and management in an entity. So it's about communicating a certain story about the entity during that period. For example, your P&L, how much profit has your company made, how much revenue has your company made, what were your expenses, and also your balance sheet, so how many assets do we have, what's our current liability, what's our working capital, and also our cash flow as well. So, does it look good on the profit side, but once we actually look how much cash we're generating and using and spending on things like CapEx, are we burning too much cash? Have we got a good cash inflow business? Things like that. So it's something you can give to a user of the information, which tells them a story about what's going on in a certain entity. An entity could be a company, it could be a trust, it could be a charity, it could be a government entity, and so forth. So the objective of general purpose financial reporting is to provide financial information about the reporting entity that's useful for the primary users. So we'll talk about who the primary users are a little bit later, for the purpose of making decisions. So some of the examples of decisions like we're making is, do they want to buy or sell or hold equity and debt instruments? About providing loans or credit, exercising votes or rights to vote, that influence management's actions and so forth. So the identification of the primary users of financial reports is crucial in determining what information should be disseminated, because the purpose of it is to tell a story to the users, so we need to know who those users are, so we can make that information as concise and straight to the point and tailored to our audience as possible. And part of that is the distinction between general purpose and specific purpose financial reporting, which we'll talk about a little bit later. So the IASB identifies primary users as those that provide equity or debt finance to the entity, such as existing or potential investors, lenders, and other creditors, and so forth. So general purpose financial reports are directed to those primary users to provide information about economic resources of the entity, claims against the entity, and changes in those resources and claims. So financial reports provide information about an entity's financial position at a point in time, and provide information about an entity's financial performance as a result of transactions and other events that change the financial position during a reporting period. Specifically, the balance sheet provides information about the financial position, i.e. the assets, liabilities, and equity of the entity at a point in time. The P&L reports on the financial performance, i.e. the income, expenses, and profitability. And the statement of cash flows reports on the cash inflows and outflows. So changes in net assets or equity are reported in the statement of changes in equity. So there's 4 key statements that we look at in financial reporting. Just to recap, it's the P&L statement, it's the balance sheet, it's the statement of cash flows, and then the final one is the changes of equity, which is probably the one that people are least familiar with. But that's just talking about equity and how's that changed over time. So all individual financial reports are prepared by an entity at a particular point in time. For example, it might be at the end of the financial year, for example, 30 June 2020, and that'll reflect the past 12 months. So that's different from management accounting, for example, which might be more regular. For example, it might be a monthly report. And they're prescribed to ensure that they're comparable with the entity's previous financial statements. So you generally have a prior year or 2 prior year comparators when you're looking at. So for example, P&L, you'll have this year, last year, the year before that. For example, you might have this year and last year. Technology advancements provides opportunities for various other methods of information dissemination that, together with the general purpose financial statements, can be incorporated into a whole suite of reporting tools to properly and efficiently address the information needs of users. So the importance of financial reporting. So financial reporting is important because of the significant level of resources under the responsibility of managers and the financial impact of the decisions that users make from relying on the information provided in financial reports. For example, think of it if you're a shareholder investing in the stock market, right? You want to know if that company is doing well. You want to know how much cash it's burning through. You want to know how profitable it is. So you, as a user, as an investor, will find this information critical because you've got a whole lot of money at stake. That's just one example, because there's many other different people who have vested interests. So shareholders, competitors, banks, suppliers, just as examples. So information needs of the users. So management of an entity can also require financial information for decision making, but they can obtain whatever information they need internally and do not need to rely on general purpose financial statements. So it's generally more the external users of the report that rely on this information. Other users of financial information include regulators and members of the public, such as community groups and potential employees. However, general purpose financial reports are not primarily directed to these users. In the conceptual framework, entities are required to prepare general purpose financial reports, specifically to assist their primary users in decision making. However, these decisions may give rise to varying or even conflicting information needs. For example, lenders are interested in assessing an entity's capacity to meet its interest and principal repayments and the level of risk associated with the loan, while investors are interested in the assessment of risk. So these varying information needs and the resulting information demands may give rise to different preferences for the measurement of assets or the timing of recognition of revenue. For example, lenders may prefer a measure of the net realizable value of certain assets because they want to know, if the company goes bankrupt, can we go in and liquidate the assets within that company? And if so, how much can we liquidate it for? The IASB's approach to resolving conflicting user information needs is to provide the information that will meet the needs of the maximum number of primary users. So maybe not everyone will be satisfied, but let's take the approach where as many people as possible are happy with it, rather than, just a few individuals who have the most dollars in it. However, according to the IASB, focusing on common information needs does not prevent an entity from providing additional information that may be useful to another subgroup of primary users. It should be noted that trying to meet the needs of the maximum number of primary users may have different implications depending on the context. For example, in some entities, the largest group of primary users may be investors, but in others, it may be lenders. So next we're going to talk about IFRS, or International Financial Reporting Standards. So the information included in general purpose financial statements, prepared for external users, for example the P&L, the balance sheet, statement of changes in equity and cash flow statements, must comply with the IFRS, the International Financial Reporting Standards, and achieve fair presentation in accordance with the definition and recognition criteria in the conceptual framework. If a conflict is identified between the provisions of an IFRS and the conceptual framework, the IFRS will take precedence. If any new provisions in the IFRS depart from the conceptual framework, the IASB will explain the departure and the basis for conclusions of the relevant standard. So what are the IFRSs? So IFRS is an internationally recognized set of accounting standards that bring transparency, accountability and efficiency to financial markets around the world. The Australian Accounting Standards Board adopted the IFRS for Australian entities required to report under Corporations Act and reporting. So there's two series of international accounting standards. Number one is the International Accounting Standards. These are the standards issued from 1973 to 2001 before the IASB was formed. The International Reporting Standards are those standards issued under IASB since 2001 and reflect the changes in accounting and business practices since that date. So ASB standards, ASBs, are the accounting standards developed by the Australian Accounting Standards Board for all economic sectors in Australia. So ASB standards are numbered by using 1 or 2 digits from 1 to 99. These are the equivalent of IFRSs. If it's got 3 digits from 101 to 999, these are the equivalent of IASs, and 4 digits from 1001 onwards have no international equivalent. So basically, to explain what's going on so far is we've got 2 sets of standards which form the basis of how you actually report the numbers in your financial statements. For example, let's take a look at revenue. Revenues in your P&L. Now, there's various different ways you can look at revenue. You could look at when the cash comes in. You could look at when the invoice is accrued, so when the work is actually generated. Or depending on if it's a specific type of revenue, for example, is it revenue from a contract? Maybe that might be accounted in a very specific way. We have to actually allocate the value of certain items in the contract, which are bundled together, split them up, and so forth. So these are the way you figure out the correct way of doing it is via looking at the standards. The standards will tell you you need to do it this way for this type of item. So the standards, there are a few different types. There's the international standards, and then there's the Australian one. So basically how it works is IFRS is an organization which is aimed, the purpose of this organization is to increase accounting comparability and transparency across the world. So an international investor who's got businesses in Australia, New Zealand, America, the UK, they can look at all of them and have some comfort that what they're looking at is comparable. For example, revenue in one country compared to revenue in another country, they're being prepared in the same way, right? Because if they're not being prepared in the same way, then you can't just say, oh, this country is doing better than this country, because it might actually be because of the way it's been accounted for. So that's the purpose of that. But because of there are some country nuances, each country generally has their own adaptation of these. So in Australia, you've got the IASs, which is the, the AASB, which is the Australian Accounting Standard Boards, which is basically adaptations of those international standards to the local Australian accounting, I guess, situation or environment. So the ASBs, the Australian ones, whilst complying with IFRS, include additional paragraphs where reporting requirements differ for specific economic entities such as Australian not-for-profit entities. These paragraphs have the prefix AUS or RDR, reduced disclosure requirements, and generally begin with words that highlight their limited applicability, e.g. notwithstanding paragraphs XXX in respect of not-for-profit entities. Okay, so moving on. So interaction between financial reporting and the regulatory environment. Who must prepare general purpose financial statements? So general purpose, I mentioned before that there's two types of, there's general purpose and there's specific purpose. Specific purpose financial reporting is for a specific audience, whereas general purpose is for a larger audience. So for example, if you're a listed company, a public company, a charity, you've got a wide audience, very general. Or if you're an ASX listed company, you've got thousands and thousands of shareholders, many who are general, mum and pops. So they're the ones who have to follow these broader accounting rules, which is generally you need to follow IFRS. Whereas if you're a specific purpose, you don't need to follow IFRS necessarily, but you need to adapt for that specific audience, basically is the difference. So an example of a company that might adopt special purpose is like a private company. Like you're an individual investor, you've got a private company that you've set up yourself, it would just be special purpose, not general purpose. So then there's the question of who must prepare general purpose. So a reporting entity is an entity that is required or chooses to prepare financial statements and can be a not-profit, for-profit, private, and or public sector. A reporting entity can be a single entity or a portion of an entity, or can comprise more than one entity but is not necessarily a legal entity. In jurisdictions adopting IFRS, legislation and other regulatory requirements usually require general purpose financial reports from entities that have issued debt or equity securities traded in a public market. In this regard, the conceptual framework indicates the reporting entity can be any entity that has existing and potential investors, lenders, and other creditors who must rely on general purpose financial reports for much of the information. In Australia, for-profit private sectors are subject to the conceptual framework, which is and must prepare general purpose financial reports when they satisfy both of the following conditions. Number one, they have public accountability. Number two, they're required by legislation to comply with accounting standards. So remember what I said before about public companies, listed companies, charities, they all have public accountability, therefore they need to prepare general purpose financial statements. Okay, so what is public accountability? So a for-profit private sector has public accountability if it has debt or equity instruments that are traded in a public market, or it is in the process of issuing securities for trading, or it holds assets in a fiduciary capacity for a broad group of outsiders as well as one primary business, e.g. banks, brokers, insurance firms, so they'd all need to prepare general purpose financial statements. So the Corporations Act requires an entity that is a disclosing entity, public company, large proprietary company, or registered scheme to prepare an annual financial report that complies with ASB rules. So this one is actually specified by the Corporations Act. Next, a disclosing entity is an entity with its enhanced disclosure securities on issue, which is like the notion of public accountability. So that's more like the charities and things like that. A proprietary company is usually limited by shares and can have no more than 50 shareholders. A large proprietary company is based on qualifying for two of the three size thresholds for revenue, gross assets, and number of employees. For financial years beginning from 1 July 2019, the thresholds for this are revenue $50 million or more, gross assets of $25 million or more, and employees of 100 or more. A public company is a company other than a proprietary company. So, for example, a listed company on the ASX would be a public company. So the financial reporting obligations of other types of entities are included in other federal or state-based legislation. For associations, the appropriate legislation is the relevant state-based Incorporated Associations Act. The two tiers of general purpose financial reporting. So the Australian Accounting Standard Board has two-tier model of general purpose financial reporting. Number one is the Australian Accounting Standards, which is Tier 1 general purpose financial reporting means an entity must satisfy all of the recognition, measurement, and disclosure requirements in Australian accounting standards, which incorporates to IFRS. And Tier 1 applies for private sectors entities with public accountability and the Australian governments either at the federal, state, territory, or local level. Number 2 is the Australian Accounting Standards, which is the reduced disclosure requirements. So Tier 2 general purpose financial reporting means an entity must satisfy all the recognition and measurement requirements in Australian accounting standards but has substantially reduced disclosure requirements relative to Tier 1. An example of RDR is the omission of the requirement disclosure of audit fees, financial instruments, and income tax and related parties. So Tier 2 applies to entities in respect of which it is reasonable to expect the existence of users dependent on the general purpose financial reports for which information will be useful to them for making and evaluating decisions about the allocation of scarce resources. So basically, just to recap what's going on here is there's a two-tier model under the Australian Accounting Standards about how much reporting a general purpose financial entity needs to submit to the government so the information is available to the public. So there's two levels in Australia. Number one is Tier 1, which is they need to report a lot. And number 2 is a reduced disclosure requirements for certain entities, which doesn't have to submit certain information. So it's reduced disclosure, basically. So one of the main criticisms about international financial reporting and international accounting standards is that it's incredibly complex. Some of the there's a lot of standards that you need to be aware of. Reading the standards is quite difficult sometimes because it can be quite specific, quite technical, difficult to understand. There's different adaptations and things like that. So this is an ongoing criticism by the financial reporting community, which is just about the complexity of financial reports. So there's a growing number of initiatives to help combat the issue, include number 1, reducing differences in reporting standards among countries. So trying to just make IFRS the main standard without, having Australian differences and New Zealand differences and so forth. Number 2, reducing reporting requirements of small and medium-sized entities. Number 3, catering to the information needs of multiple stakeholders. Number 4, improving the content and structure of the primary financial statements. Number 5, clarifying disclosure requirements and improving the usefulness of disclosures. Number 6, improving understanding of the existing requirements and helping entities make better materiality judgments. Number 7, considering how management commentary outside the financial statements could better complement and support the financial statements. And number 8, improving communication between preparers and users by enabling information to be delivered in an electronic format. So then in the notes we're just going to go through a deep dive of these different points. So I might just skim over these because we basically explained most of them. So let's talk about the conceptual framework next for financial reporting. So this is the structure of the conceptual framework for financial reporting. So number 1, objective. So it sets out the objective of general purpose financial reporting. Number 2, qualitative characteristics. It provides guidance on the qualitative characteristics of useful financial information. Number 3, financial statements in the reporting entity. This describes the objective and scope of general purpose financial statements as well as the reporting entity concept. Number 4, elements of financial statements, which provides the definitions of the elements of financial statements. Number 5 is recognition and derecognition. This sets out the recognition and derecognition criteria. Number 6, this is measurement. This provides guidance on the measurement basis, including historical cost and current value. Number 7 is presentation disclosure, which provides guidance on classification, presentation, disclosure. And then finally, 8, concepts of capital and capital maintenance. This provides guidance on the concepts of capital and capital maintenance. So just to explain what this is in layman's terms is the accounting standards are quite complex, right? And they're quite technical. There's a lot of information in there. So this framework is as a means of creating this high-level structure with qualitative terms. So qualitative means, with words rather than numbers, to kind of help people understand a little bit more about the accounting standards and just provide high-level advice. For example, what's the purpose of financial reporting? Why are we doing it? What are some good concepts of financial information that is actually useful to the users? For example, being clear, being concise, being straight to the point, being adapted to the specific user group. What would actually be in the financial statements? So having specific reports, for example, having director sign off, and so forth. De-recognition and recognition and measurement. So when you actually get to the transactions, like for example, let's say you've got a property, for example. Once you actually purchase a property, how do you actually account for it? Well, basically you have to recognize it initially, put it on your books initially, and there might be de-recognition as well. For example, if you sell it or if you write it off or whatever it is. So how do you actually do that? Why do we do that? And then measurement as well. So are we doing that? Are we bringing that property at the cost we paid for it and keeping it that, or are we revaluing it to market value every year, or how are we actually accounting for it? Or if it's like a business, you might do a discount cash flow every year to figure out what the carrying value of that business is. And then, do we need any additional notes? So you've got your numbers in here, but do we need any explanatory notes as well in the presentation section and so forth? Things like that. So the conceptual framework provides a formal frame of reference for what type of transactions should be accounted for, when the effects of transactions and events should be recognized, how the effects of transactions and events should be measured, how the effects of transactions and events should be summarized and presented in financial statements. All right, let's talk about the objectives and limitations of general purpose financial reporting. So I guess the alternative that we could consider is management reporting, right? So for example, management reporting, it's easy to get the information, you can get it on a monthly basis. What are some downsides that you can think of off the top of your head in relation to general purpose, in relation to management accounting? Well, number one, there's no universal set of rules, so it's not necessarily comparable, right? Maybe the information isn't as accurate, right? And maybe it doesn't have as much explanatory notes and things like that. Those are just a few ones. But some of the advantages is you can easily get the information. It might be easier to understand. It's more regular. You might get it on a monthly basis as opposed to annual financial reports, and so forth. But let's do a deep dive now. So some of the limitations of general purpose financial reporting. Lack of familiarity with new types of information. So if users of financial statements are not familiar with an item of information, it's difficult to assess its usefulness to their decision-making process. Preparers will be then faced with difficulties in trying to assess if the new items or information should be recognized under an existing category in the financial reports or disclosed separately. And some may not have the technical expertise to understand it. For example, present value calculations, you've got to do discount cash flow, or maybe it's technological awareness, for example, crypto assets. Next is decision usefulness may vary among users. So the personal beliefs and values of users may determine the information that they tend to use in their decision making, for example, environmental concerns. The difference in what users find relevant are also likely to depend on the decision being made. For example, what information is required for a long-term contract differs from a union negotiating higher wages. Next is capable of multiple interpretations. So preparers may have a different perception of what is useful information to users than the users themselves. For example, using fair value for assets may be to assess the entity's future economic benefits versus other entities. However, value and use may be better at capturing the management's plans and expectations regarding assets. Time and cost constraints in preparing GPFS. So due to time and cost constraints in preparing general purpose financial reports, it's not possible for entities to provide all the useful information that will meet all the varying needs of users. So when a user requires specific information that has not been disclosed in an entity's financial reports, the ISB recommends the user or the use of the source, such as general economic conditions and expectations, political events, and political climate and industry and company outlooks. Okay, so let's talk about principles established in the conceptual framework. So the first concept, which is, these are all the concepts that we talk about in financial reporting, which are commonly referred to throughout this subject, and also you'll find in the real life, in the real corporate world as well, we talk about these concepts as well. So the first concept is accrual basis, and most of you will already be aware of this. Some of you may not be, but it's basically, if you go back to Accounting 101, you will learn the difference between accrual accounting and cash accounting. A cash accounting is basically you record things when the money comes in. Accrual accounting basically records the income or expense when it's earned, right, rather than when the cash is received. For example, let's say you're working as a plumber. You then issue an invoice with a 30 days payable. Let's say your invoice is $1,000. You would actually record the revenue on the day you issue the invoice, not the date you're paid. But if you're running a business as a cash business, then you might record your revenue only when you receive the cash. Similar for expenses as well, because you recognize the expense when it's incurred rather than when the cash is paid. For example, when you receive an invoice, even though you haven't paid it yet, you're going to record the expense then. Okay, next is going concern, and this is a very important concept, particularly in the auditing, once you get to that next subject. Basically, the financial statements prepared in accordance with the going concern assumption presume that the entity will continue to operate for the foreseeable future. So the carrying amount of assets and liabilities in the statement of financial position are normally based on the going concern assumption. So basically, if you're reading the financial report, you want to know that the company is going to be around in years to come. Otherwise, you're not going to be, it's going to be a material impact on your decisions in terms of what to do with your money. So any financial report is assumed that the company will continue on into the future. But once we get to the audit module, you see that sometimes when the auditor, they go through it and they go, okay, well, actually, I don't think this company might continue. For example, it might have huge amounts of debt falling due and there's not enough cash flow in the business, or maybe revenue's falling off a cliff, it's declining 50% a year, and the auditor doesn't see it as sustainable. It may deem this as, not to be going concern, and they'll actually give it a qualified audit opinion, but we'll get to that once we get to the audit chapter. Okay, so qualitative characteristics of useful financial information. So remember what I explained what qualitative meant. It was using words rather than numbers. So for example, if you're describing something in certain characteristics, that will be qualitative, whereas if you're describing something in numbers, it's going to be quantitative. So the first characteristic is relevance. So information is relevant when it can influence the decision of users, which can occur through predictive or confirmatory value of its financial information. Here's some more here. So faithful representation. So it's actually being represented to the user honestly. And then also comparability. So you can actually compare it year on year and against other companies. Verifiability. So if I would request a certain invoice, I could get an invoice for that. We could verify those number. Timeliness. So we'd get the report each year, for example. And understandability. So we can actually understand it. It's clearly laid out. It's in English. It's, not overly technical while still following the standards and so forth. Materiality is the next qualitative concept that we're going to be talking about. So materiality is a concept which we'll talk about a lot in the audit subject as well. So this refers to amounts that are considered large enough to influence the decision making of primary users. For example, when we're doing an audit and we see a variance of $1, we're going to say it's not material, not a big deal, move on. But if we see a variance of $10 million, that's going to be material. It's a large amount of money. That is going to be a material amount, so we do need to do something about that. We need to follow up on it or issue a qualified audit opinion, which is, in other words, a bad audit opinion. Faithful representation. This is the concept that the financial information faithfully represents the effects of transactions and events that they purport to represent. So basically, the people preparing it have honestly prepared it, completed everything. They're not trying to do anything dodgy or hide anything, basically. Next, in the qualitative characteristics, and this is like a subcategory of qualitative characteristics called enhancing qualitative characteristics. So these ones are more these first ones are the fundamental qualitative characteristics. It's the bare minimum that you need for it to be, not, irrelevant or not, wrong. And then these ones are basically, okay, going that next level up, just improving people's understandings of the financial reporting. So the first one that we're going to talk about is comparability, which is basically your ability to compare the numbers in this with the last year, with similar entities and so forth. Because I mentioned it earlier on that if the numbers just aren't prepared in the same way, you can't isolate that variable when you're, for example, we're trying to find out why revenue might have decreased year on year. We want to know that the way it's been accounted for isn't a factor. So we can actually just look at the underlying drivers within the business for why revenue might have declined. That's just one example. Verifiability is basically this concept exists if knowledgeable and independent observers can reach a consensus that the information is faithfully represented. So no one's saying, oh, this is completely wrong. Most of the users are saying, yes, we believe this is correct. Timeliness. So this is the relevance of the information due to timing. So basically, that we're getting the information on a regular basis, consistent with prior years and what's being communicated to the users. For example, some companies might have half-year reports, some companies might have annual reports, and just receiving that on a similar timeline to previous years, so you can make timely decisions. Understandability, which is the information is clear, it's concise, and it's classified, characterized, and presented. So the user should be able to understand how it's presented, is what this means. So this next section is just basically talking about, okay, all of the enhancing qualitative characteristics that we talked about. So all these ones in the diagram here. So comparability, verifiability, timeliness, understandability. How do we actually apply that, to the financial, statements? So although enhancing characteristics improve the relevance or faithful representation of the information, they do not make irrelevant or unfaithful represented information useful. If information were omitted from the financial statements, rendering them, the inconsistent omission of that information over multiple periods may provide comparability, but it would not make the information useful. For example, if an entity omitted several material subsidiaries from its consolidated financial statements, repeating this omission in each reporting period may provide comparability, but it wouldn't faithfully represent the financial position and performance of the group, nor be useful for decision making. So whenever we prepare financial information, there's always a cost, whether that's the time cost, the resource costs, for example, using employees, or the financial cost, the actual cost of paying salaries, using external advisors, paying accountants and auditors, and listing fees and things like that. So there's always a balance between the two, making sure it's useful and reliable, but also making sure that the cost is reasonable as well. However, there is a flip side to that, is that if you do provide useful financial information, it does facilitate the efficient functioning of capital markets, which effectively lowers the cost of capital, which reduces the cost of doing business. So the cost of preparing that useful information kind of evens out over time in the long run and in aggregate. However, the cost of meeting all information needs is normally prohibitive, therefore some information may need to be left out with regards to materiality, and that's okay. For example, the ISB provides specific exemptions as a lessee to not apply lease recognition, measurement, and presentation requirements to leases of less than 12 months, where the assets being leased is of low value, right? Because there's not much point. It would cost you a lot of time, cost you a lot of money in paying accountants to do all the calculations, get all the leases. It's going to disrupt your operations. For what's the point, right? It's 12 months, they're low value assets. So the ISB is saying use your professional judgment. And this is a concept which comes up a lot, especially in the auditing subject, is you have to use professional judgment, right? Not every variance is going to be the end of the world. You have to find the point where you say, I feel comfortable with, and the point where this is grey, and anything over that grey line, we're now saying is an issue. And that's basically the concept of materiality. Okay, so now let's talk about the elements of financial statements. So the key decision areas in accounting for transactions in other ends. We've got definition, we've got recognition, we've got measurement, and disclosure presentation. So these are anytime you look at a certain transaction, whether it's an expense or purchasing an asset or incurring a liability, you're going to have these questions. First of all, definition, does it actually satisfy the definition of a liability? Does it actually satisfy the definition of an asset? Because sometimes there's these grey areas, and something might be treated as an asset, in your mind, but then per the accounting standards, it's actually treated as an expense, for example. Generally, it's pretty clear cut, but you actually still need to consider the definition and say, okay, does this asset actually satisfy the definition of an asset per the financial statements? Sorry, per IFRS. That's the first checklist. Then we can move on to the next one, recognize it. So how do we actually recognize it? Do we recognize it on a cost basis? Do we do an uplift to market value? How do we recognize the purchase costs associated with it? Whether you've got interest expenses, you've got installation costs, have you got any transaction costs? Can you actually capitalize it into the cost of the asset, or do you have to expense it? So that's some of the questions that we'll face with recognition. Next is measurement. So both upfront measurement and ongoing measurement as well. So do we do it at cost? Do we do it at market value? And each year after that, do we have to test for value? for example, for some intangibles, we might have to test the value of it, doing a discount cash flow versus the value in use. And if the asset's not worth that, then what we'll do is we'll actually impair the asset. Or maybe if it's a property that's recognized as fair value, each period we have to hire a valuer, figure out the value of the asset is, and revalue that asset upwards. Or maybe it's an asset that's valued at cost, and we just leave it at cost value. Or maybe we depreciate it. If it's equipment, we actually have to depreciate each time, and therefore the carrying value of it, or the measurement, is the written down value of that each year. Same for liabilities, and even same for equity as well. And then finally, disclosure presentation. How do we actually report this in the financial statements? What notes does this fall under? What information do we need to accompany with this number? So let's talk about the different, assets, liabilities, and equity, and so forth. Everyone kind of knows what an asset is, and everyone kind of knows what a liability is, but a lot of people don't know the specific definition of what an asset is or what a liability is, per their standards. And again, this is really important because, if it doesn't satisfy all the definition and you think it's an asset, it doesn't mean it's an asset under IFRS, and we can't actually report it as an asset. So it's important to know these definitions. So first of all, the definition of an asset is, per the IFRS, it's a present economic resource. So it's today's resource, controlled by the entity as a result of past events. For example, you might have paid money for it, that's the past event. You now control it, and you now control that economic resource today. An economic resource is a right that has the potential to produce economic benefits. So for example, land, you could produce corn from that land down the track, or if it's a property, you could produce rent from that property down the track. So these are the potential, not guaranteed, but potential to produce economic guarantees. So the three components. Number one, so it's a right. So you have the right to control this asset, to build it, to sell it, to develop it, to split it, all these kinds of things. Number two, it has the potential to produce future economic benefits. So I gave some examples before. So land can produce corn, you can sell it, you can build apartments on it. If it's a property, you can lease it out, you can build a business on it, and so forth. And number three, it's controlled by the entity. So that some of the areas where you might get caught up on is, for example, inventory, right? So because with inventory, there's always a point. At what point do you own the inventory versus the manufacturer? Is it when you pay for the good? What if you take control of the good and store it with you, but you haven't paid for it? What if it's on consignment? Do you actually own it at that point? That's an important one, because if it's not, if you don't own it technically, if you don't control it, then it's not an asset. You can't record it, even if it looked like an asset. So assets are considered to result from past events, such as being purchased or produced, and thus it's important to distinguish between past events and future transactions, as it's not considered an event until the event occurs. For example, a firm has an operational plan that requires them to purchase machinery in year one. The definition of an asset is only met once the asset is purchased. Okay, let's talk about liabilities. So the liability is a present obligation today of the entity to transfer an economic resource as a result of past events. So the three components of this. So number one, the requirement for the entity to have a present obligation. For example, I have a loan from the bank, a mortgage, $500,000. I have an obligation at some point in time to repay that $500,000. Whether that's in monthly installments of my mortgage, whether it's when I sell my house, I have to repay it all back. Next, the obligation is to transfer an economic resource. Okay, money is an economic resource, or you could be trading it for inventory, you could be trading it for debt or equity in a company. These are all economic resources. And number three, the present obligation exists as a result of past events. So a present obligation may be legally enforceable, or it may arise from normal business practice, custom, and a desire to maintain good business relationships or act in an equitable manner. For example, a firm selling goods may accept the return of faulty goods for a full exchange, even after the contractual warranty period has expired, to maintain favorable relationships with the customers. Therefore, that would satisfy the definition of liability, even though there's no written contract. The written contract probably even says it's not a liability, but we'd still recognize it as a liability because it's business custom. Next, the present obligation should be strictly related to a transaction or event that occurred in the past, and this transfer of economic resources is known as the settlement of the liability. Okay, finally, let's talk about equity. So equity is the residual interest in the assets of the entity after deducting its liability. So this is where we come back to that old formula, ALO, assets minus liabilities equals owner's equity, or equity. Yep. Okay, And then income, which is, now we're talking about P&L side. So income is the increase in assets or the decrease of liabilities that result in increases in equity other than those relating to contributions from the holders of equity claims. So there's two essential characteristics. So number one is an increase in assets or a decrease in liabilities. Number two is an increase in equity other than a result of a contribution from owners. So some people think of revenue or income as, issuing an invoice and receiving cash. But that's not always the case, right? For example, you might issue an invoice to someone, and instead of them paying you money, they might just pay down your loan and say, look, I'll just forget this portion of your debt that you owe me. So, you'd still record that as income even though you haven't actually received any cash for it, which is why the definition goes two ways. It's either an increase in assets or a decrease in liability. And then expenses is the decrease in assets or increase of liabilities that result in decreases in equity other than those relating to distributions to holders of equity claims. So the two essential characteristics of an expense is number one, a decrease in asset or an increase in liability. And again, going back to that example about revenue, it's not just about, an expense isn't just about paying cash for something, right? You might actually incur an increase in liability which would generate an expense. For example, your employee liabilities. So every company has to pay staff 4 weeks of annual leave or 8 weeks of long service leave after 10 years, or it might vary state by state, but that's generally the rules. The formula for, you need to recognize a provision for that liability, that you need to pay out those 4 weeks of leave or the 8 weeks of long service leave, and obviously you have to discount it based on probability and time and all that. But the general journal for that would be credit liability to increase your provision, but the other side is going to be an expense. So an expense could also just be an increase in liability on one side to the expense. But it could also be a decrease in equity as well, other than those arising from the distributions to holders of equity claims. So there's various different kinds of expense situations which you'll learn over the course of this subject. So criteria for recognizing elements of financial statements. So recognizing elements of financial statements involves capturing in words with a monetary amount the items that meet the definition of asset, a liability, equity, income, or expenses. The monetary amount at which an asset, liability, or equity is recognized in the statement of financial information is recorded as its carrying amount, which is the recognition component. And an asset or liability is only recognized if that asset or liability and any resulting income expenses provides users of statements with information that is useful. If it is uncertain whether the element exists or if the probability of an inflow or outflow of economic benefits is low, the information provided by recognizing that element may not be relevant, therefore the element may not need to be recognized. So this is saying is just because it satisfies the definition above, it also needs to be relevant to users. And if it's not relevant, just because it satisfies those definitions doesn't mean you just necessarily have to recognize the asset, liability, or equity. So once you've figured out how you're actually going to initially recognize your initial asset or liability or equity, and the specific standards for each different type, which we'll go through later. So it sets out how you need to do it. But the next question is how do we actually measure it? So there's two questions generally with this. Number one, how do we initially recognize it, and how do we subsequently recognize it? What that means is, when we first buy it, and I gave you an example of this before, when we first buy it, do we recognize it at cost? Do we do an uplift to market value? And so forth. And number two, in year one after that, and year two after that, and year three after that, do we recognize it? Do we continue to recognize it at cost? Do we depreciate that asset and recognize it written down value? Do we continually test it each year and see what the value in use or the cash flow from it is? And then discount it, and we might need to impair the value, or do we recognize the fair value every single year and actually adjust the fair value every single year? So these will all be specified in each individual standard depending on what type of asset or liability that you're dealing with. So under IFRS, there's generally these are the different types of measurement bases. There's a few different ways. There's the cost-based categories and there's the value-based categories. So cost-based is the ones where you just recognize how much you paid for it. So cost/historical cost or amortized cost And this is basically where you record a book value, and then you may or may not depreciate it / amortize it. They basically mean the same thing. As if it's got an effective life of 10 years, each of those 10 years you're writing off that proportion of it. So for example, 10% each year, you're writing off an extra 10% thereafter. Another one is value based. So that's looking at, okay, what's the value as opposed to the cost. Cost is what we paid for it. Value is how much it's worth. So this could be fair value. Getting a market valuation done where they say, okay, based on similar assets or liabilities, we think it's worth this. Could be fair value less cost of disposal, where you actually have to figure out how much it's going to cost to dispose of it. For example, a mine, it might have significant closure costs, which we need to recognize in the cost as well. Could be the net realizable value, so how much could we actually sell it for today? Fulfillment value and value in use as well. So these ones you actually have to do some actual valuations of how much it's worth to you. So doing some modeling, what's the cash flows from this business discounted to today's current cost. So now we'll do a very quick run through of some of these different measurement approaches. So first of all, cost. So some of the advantages of that, it's pretty easy to understand, it's relevant to decision making, it's reliable, it's inexpensive to implement. Generally most people understand what cost is, it's just what you paid for it, right? The disadvantages is it has limited relevance for decision making because it doesn't have a lot of predictive value, and it can distort the value of it. For example, you might have bought a property in 1980 for $100,000, might be worth $10 million now, but you're still recording it at cost. It doesn't really add a lot of value to people who want to decide whether they want to invest or not because they don't know how much it's worth today. Next is it undermines the faithful representation of it. Again, if you've got assets which are being undervalued, that might not be faithful representation. Number 3, undermines the comparability. You want to know, you want to be able to compare it to different entities. How much are the assets? If you're writing it costs, you're going to be understanding the assets, for examples. And reliability. How can you rely on the rest of the financial statements if this is the choice of measurement on a particular asset, which is materially understating it. Amortized cost is another methodology quite similar to the one above, but it's basically the amount at which the financial asset is measured at initial recognition minus the principal repayments plus the cumulative amortization during the effective interest period. So you typically do this for your financial instruments such as bonds is probably the most common one you do this. It's basically, I guess you need to understand the way the bonds work is a company will issue a bond. So it's $100, for example, per bond, and it's payable in 10 years' time. So that means during that time, on year 0 or day 1, the investors will pay $100 for the bond. The company will get that $100. The investor will hold the bond. Now, each year, the company will pay each investor the coupon rate. So maybe that's 5%. So they'll pay $5 a year to each of these investors. So they'll pay that for 10 years. Now they'll get to year 10, after which they're paid 10 times 5, they're paid $50, right? But also at the end of that, the bond expires, so now the company needs to pay back the people in exchange for the bond. So they're going to pay the $100, the face value of the bond, back to those shareholders, or back to those bondholders, I should say. So in total, the bondholders over the 10 years would have received $100 plus $50, so $150 total. Now this is important to measure the value of the bonds because there's a few different elements at play. Number 1 is figuring out what the current value of all those cash flows are, so all of those coupon payments. Because one of the key lessons in finance is that $1 today is worth more than $1 tomorrow, and the reason for that is inflation, right? It's like when people tell you stories of people buying a house in 1980 for $10,000. The reality is if you compound inflation 3% a year for 50 years, it's going to make that property worth, triple or quadruple that. It's the time value of money, right? So hopefully some of you are aware of that from doing some corporate finance or courses at university and so forth. Anyway, so we need to take that into account, the time value of money, and we do that by discounting all of the cash flows. We add up all of the cash flows, discount it to today's value. That's the discount, that's the present value of future cash flows is how we call it. We also need to take into account the final payment at the end, which is the $100 that needs to be repaid in year 10, but that's not going to be a lot of money because if you can take into account the inflation during that time, it's not going to be the same as the $100 that they received this year. So you basically take all of that into account, the initial amount, the payments over time, the final amount, and also the interest rate, because that's going to affect the valuation. If it's a low interest rate, that's going to inflect the inflation rate over time. If If it's low inflation, it means, the money in 10 years' time is going to be worth similar to the money today. But if it's a high interest rate, the money in 10 years' time is going to be worth only a fraction of what it's worth today. Anyways, that's amortized cost. It takes into account all of those. So there's a section from the textbook which shows you an example of this, which you can read through in your own time. Basically, you plug in this calculation: present value equals the future value over 1 plus I, which is I is the interest rate, plus N is the number of years. And you plug that in and it calculates the present value of all of the payments. Okay, so next one is fair value, which we talked about before, and that's basically if we were to sell the asset in an orderly transaction between market participants at the measurement date, how much would the asset be worth? So the key concept is orderly transactions. So, it can't be a forced transaction like a liquidation and distress sale. It needs to be, a reasonable market rate, sale. And IFRS 13, it actually has tiers of fair value. So number one is, the most accurate fair value price. For example, a quoted price for an identical asset or liability. So shares, for example, at any given minute during the day how much your asset is worth, because you've got identical stocks in a liquid market, in an active market, so it's almost perfect fair value pricing. Number two input is a model with no significant unobservable inputs. So this is basically a model. For example, the entity may be using quoted market prices for comparable assets, liabilities, or equity instruments in active markets. So you're not getting the exact same share to compare it to, but you might have, for example, let's say you've got you've got a company, right? Let's say you've got a childcare company. There are other childcare companies out there, but you don't know, it's not the same company, it doesn't have the exact same situation. So you can look at some comparable things, like what multiples are trading at, and can use that to compare the value of business. So it's fairly accurate, but not as accurate as if it was in a liquid quoted market. And then the bottom one is level 3, which is basically unobservable inputs. And that's basically where the best information is usually assumptions about market. So for example, you've got a car, for example. You've got the car has a different manufacturer year. It's got a different, it might have different condition. Like some parts might be worse, might have rust, might be a different color, might have certain add-ons. So there's no exactly comparable car. So all you can do is basically make assumptions about what the market participants might pay for it, because there's no directly comparable assets. So the disadvantage of doing fair value is it lacks relevance, because it's not relevant in relation to assets that the entity does not intend to sell, such as financial instruments that the entity intends to hold to maturity. And then problems with reliability. So, fair value is basically the highest that someone's going to pay for it. How do you know that what someone's going to pay for it? You might get that valuation wrong. It does involve judgment. So current cost is the current cost of an asset, which is basically the cost of an asset at the measurement date, comprising the consideration that would be paid at the measurement date plus the transactions cost that would be incurred at that date. For example, the reproduction cost or the replacement cost. How much would the company have to pay to get an exact replacement of that particular asset? Okay, so let's move on to fair value less cost of disposal. So that's basically the same as fair value, but you also take into account the cost of disposal. I gave the example of a mine before because it's going to have significant disposal costs at the end. And then finally, net realizable value. So that's basically in the ordinary course of business, what would the business receive in its current state, right? So if you were to sell things today, how much would you get for it? So maybe you could get a higher value under fair value if you waited out, if it wasn't a for sale, but if you were to sell it today, you'd have to go to a dealer, you'd have to accept a discounted value, for example, on your car. Fulfillment value is the present value of cash or other economic resources that an entity expects to be obliged to transfer as it fulfills the liability. Those amounts of cash or other economic resources include not only the amounts to be transferred to the liability counterparty, but also the amounts the entity expects to be obliged to transfer to other parties to enable it to fulfill the liability. Value in use. So this one's going to come up a little bit later when we start talking about intangibles, because for some intangibles we actually have to do annual tests of value, and the way we do it is look at what's the value in use. So we look at the cash flows of the business. So similar to how we looked at the bonds, what's the annual cash flow for every single year of the business that we're currently using it for? So we're not looking at market participants, we're looking at our own use of it. Then calculate what the net present value of all those cash flows are and sum it up, and that's the value in use of your asset. So some of the issues for value in use is reliability, because it's specific to that particular company, and you might get a higher value somewhere else at fair value. Someone might have a different use for it, and so forth. And then understandability, because it's based on management expectations. While the discount rate used to calculate the present value is based on market conditions, if there is there's a conflict whether the value in use should reflect management or market expectations. And just another point around that, it's also very, very technical, and also uses a lot of assumptions as well, which are easy to get wrong. So here is a bit of a model in the notes in terms of what you do for a value in use model. So there's two components, there's cash flow and discount rate. You add up all the cash flow at the discounted rate, right? And to calculate the discounted rate, it's basically your weighted average cost of capital, or your WACC, your incremental borrowing rate, or your market borrowing rate. And your cash flow basically includes all of the cash flows from using an asset, cash flows, outflows required to generate inflows, net cash flow from disposal at the end of useful life. So I'm not sure how helpful this is to you. I think it's just simpler to think about adding up all the cash flows, because then logically you can figure out what cash flows a business would have. Obviously you're going to have your revenue, less your expenses, less any costs associated from your business as well. And you'd adjust out your non-cash expenses from your P&L. For example, you wouldn't include depreciation, even though that's an expense in your P&L. It's not generating any cash, it's just an accounting adjustment. So you wouldn't include any of those. You'd only include your cash adjustments, and you just discount it based on to present value. So I'm not sure how useful this is. Maybe you prefer to think from flowcharts. I just prefer to think logically. So present value is basically what we were talking about up here. It's basically discounting all future values to the value of it today, because of the concept that I keep talking about, which is $1 today is worth more than $1 tomorrow. So this is just saying uncertainty of future cash flows. So the reliable measurement of the present value of individual assets and liabilities is problematic because future cash flows often occur under conditions of uncertainty, even for contractual amounts. It's hard to predict what's going to happen in 10 years' time. There could be a war, there could be a recession, your factory could burn down, you could lose a certain contract, the exchange rate could change. There's so many different variable factors that occur over 1 year, 2 year, let alone 10 years time, right? And then on top of that, you got to estimate what's your growth rate, are your costs going to increase, are your cost margins going to change, what's the interest rate on your cost of capital going to be, and all that stuff. So it just says that where there is sufficient objective evidence that where the role of uncertain future events must be considered, where there's sufficient objective evidence that they will occur, it must be based on reasonable and supportable assumptions. And IAS 37 requires that the amount recognized as a provision must be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period. So it's basically just using your best estimate. So you are allowed to use present value. And of course, one element of calculating present value, other than cash flows, is what's the actual discount rate that you're going to use. And investors require a rate of return in line with the systemic risk of an investment. So high-risk investments generally have a higher interest rate required to fund it. For example, you're going to a bank to start a business, you don't have any capital. The bank's going to require a high interest rate because you're higher risk. So that would be your cost of borrowing, right? But if you're a company like Apple, who's tried and true, very low risk, got a lot of assets as collateral, they'd have a very low, and also access to large scale of capital, they'd have a very low rate. And it's saying here that there's just lots of different things you need to take into account when choosing an appropriate discount rate, right? What's the level of risk, both systematic and unsystematic? So, unsystematic would be specific to a particular asset in your company, for example, whereas systematic might be a market risk. How are global interest rates traveling? So typically the discount rate used, and this is specified in the Australian accounting standards, is to use high quality corporate bonds at the market rate. So this usually solves the problem for most companies. So what is current rate versus historical rate. So current rates are based on the discount rate that is current at the end of the reporting period, maybe adjusted for risk, whereas historical is more about what has it historically been over time. So a few standards actually specify the use of current rates. So for example, employee benefits. So that's for calculating, for example, the long service leave or the annual leave provisions, which you need to discount to today's value, because you might not pay your long service leave, for example, until 10 years time. So what's the value of that today? You need to have a provision for that. Impairment of assets. So you need to calculate the value and use of your assets, and you need a discount rate for that. And then finally, contingent liabilities, contingent assets. So you might have to pay, a legal case or something in 3 years time. You get to discount that to today's value when you record it as a provision. So application of measurement principles in IFRS. So next we'll be talking about a few specific provisions within IFRS which have good examples of application of measurement principles. So by that we mean so each year and also initially, how do we recognize the value of the liability or the asset? Do we use cost? Do we use fair value? Do we use amortized cost? Do we use fair value less cost of disposal? Do we use value in use, for example, upfront when we first buy it or incur the liability? And how do we report it each year after that? So we've got a few examples of important or relevant or new standards that we should be aware of in terms of how it works and how you actually account for it. So the first one is leases, IFRS 16, and this is actually a new one, which began from 1 January 2019. It's a fairly important standard. So the objective of IFRS 16 was basically introduced because there was a deficiency in how operating leases were reported on financial statements. There's two types of leases, which you might have been taught in university, right? There's your finance leases and your operating leases. Your finance leases are typically the ones where you're just leasing an asset to buy it. For example, you take a lease out on a piece of equipment. It's over 10 years, and at the end of 10 years, you've paid down the asset. You take control of that asset, right? Whereas an operating lease is probably more like where you're using the asset, but not for the intention of actually purchasing it at the end. So, for example, a rental lease might be an example of an operating lease because you're using the premises. You don't have any intention of buying it. You're just paying money so that you can use it. But it could also be, for example, airlines. There was a lot of airline operators which were leasing aircraft without the intention of purchasing at the end, recording as an operating lease, right? And the implication of that is how it used to be reported in financial statements. So basically, finance leases meant that you actually had to record the asset and liability in your balance sheet. Operating leases, you didn't. You only recorded the expense. And it meant that you had these companies, especially like airline companies, because they had billions and billions of dollars worth of, aircrafts, which if they were finance leases, they would have had to report those on their balance sheet. And a lot of people were saying, especially in the finance community, were saying, this is materially misrepresenting the financial statements of airlines and other companies, because investors don't know that they've got these billions and billions and billions of dollars of liabilities sitting on their balance sheets that they have to pay off. So what happens if something like COVID hits? The company still has to pay these leases, right? But they're not on the balance sheet. So, that's materially misrepresenting what's going on. So this new IFRS 16 was meant to kind of change that. And what it means is that all operating leases also need to come onto the balance sheet. We need to recognize all of the asset. We need to recognize all of the liability. So kind of similar to how we did finance leases historically. And then you do a discounted value of all the future lease payments. That's calculated to be the asset of the lease. So I do have a resource which I can show you, which just shows you the journals for leases and how it's actually calculated. It's in the CPA notes folder over here. Let me just bring it up here in other resources. So here we have this is a really useful document. It's part of our Fin Notes product, which you can purchase on our website. So basically, what you do is you find the relevant chapter within Fin. So for example, we're talking about leases. We'll go to the leases chapter. We'll then go here and say, okay, let's figure out how we actually need to account for it. So first of all, we need to add up, what's our lease liability calculation? What's our lease payment schedule? So you do your start date, which is your present value of minimum lease payments. So you basically add up all of your lease payments, figure out what the present value of it. That's your asset value. So you can see down here that the right of use asset, the journal for that is debit right of use asset, credit lease liability. So you basically recognize the lower of present value and minimum lease payments and fair value. And then your liability is the same. And then each year after that, you can just follow this schedule over here, where basically you go insert your initial opening liability, which is your present value, minus your lease payment, which is equal to, B minus D. Then you calculate your liability reduction, you calculate your interest expense, which is times the implicit interest rate. That gets you to your closing liability reduction, and then this is your prior closing liability, and just keep doing that year after year until this gets to 0. So that's your lease payment schedule. This helps you calculate the present value of minimum lease payments, and then there's all the journals down below. So this is important for a few reasons. Number one, of course, you need to do the present value. Number two, the initial recognition is the lower value of present value minimum lease payments and fair value as well. And number three, this was hiding. Okay, so there's 2 recognition exemptions available to lessees. Number one, a lease is considered a short term if it's no more than 12 months. A short-term lease exemption can only be applied. So basically what we talked about before, if it's an asset that's less than 12 months and immaterial, you don't have to follow the rules here. But the assessment of whether the lease is low value, it needs to be low value as well, is based on the value of the underlying asset when it's new, cannot be applied to subleases. Okay, so let's now move on to the second standard that's called out by the textbook in regards to application of measurement, so it's employee benefits. And this is, think about your annual leave provision, your long service leave provision. So you need to actually recognize provisions for these. So as with all liabilities, you need to separate your short term from your long term. And you usually see with companies on their balance sheet is they'll still have employee benefits provision, but they'll just have split it up by short and long term. And basically short term is anything less than 12 months, due within less than 12 months. So short term examples includes wage and salaries, profit, like unpaid at the end of the financial year, profit sharing and bonuses unpaid, non-monetary benefits such as medical care unpaid, short term compensated absences such as annual leave unpaid and sick leave unpaid. So the liability for short-term obligations should be measured at the undiscounted amount expected to be paid on the settlement of the obligation. So anything less than 12 months, you don't need to discount at the present value. I mean, that's common sense, right? Within 12 months, it's the same year. It's still year 0, so there's no discounting. It's only when you're dealing with liabilities in year 2, in year 3, in year 4, up to year 99. All of those years you discount. Now, it's important to distinguish between accumulating and non-accumulating, investing and non-vesting, but because both of these are going to have implications as to whether or not you need a provision for it. Now, an accumulating compensated absence arises where the employee can carry forward their entitlements to future periods and will lapse if not fully used within the current period. Just to clarify, accumulating means that, for example, your sick leave, you get however many weeks, 2 weeks a year, right? If you don't use it, at the end of the year, it will accumulate and roll forward to the next year, right? That would be accumulating. If it doesn't, then it's non-accumulating. For example, if your company's policy is use it or lose it, and you've got 20 days a year, and after that it resets, then it's non-accumulating. Vesting, on the other hand, is basically whether the employer is obligated to pay any unused amounts of that when the employee leaves. For example, your annual leave, when you leave your job in Australia, if you have any annual leave liability at the end of it, your employer needs to pay that out to you, even if it's terminated. If it's non-vesting, for example, sick leave is non-vesting, any unused sick leave at the end when you leave your job will not be paid out. So let's first talk about non-accumulating / accumulating and whether that's going to, and how we actually, what's the implication for provisions. So if it's non-accumulating, the cost of providing the benefit is not recognized until the absence occurs. Okay, if it is accumulating, then it is. when compensated absence is accumulating and vesting, for example, annual leave, for example, long service leave, a liability for accumulated compensated absences is recognized as employees render services that increase their entitlement to future compensation. So basically think about it this way, if this is too difficult to understand. Annual leave accumulates, and when you leave, it gets paid out to you. Therefore, the company needs to provision for it, because on the day it gets paid out to you, they need a provision ready to go, right? That's the best way to think about it. Whereas sick leave, since they don't have to pay it out, they don't have to have a provision for it. That's probably the easiest way to think about it. Now, it's also important to consider those long-term employee benefits, which is mainly just your long service leave, right? But it also could be, an LTI or something like that as well. So in countries, especially Australia, LSL is an entitlement that accrues to employees as they provide services. So basically, typically you work 10 years, and this varies state by state within Australia, but typically you work around 10 years, you get around 8 weeks leave. And how company pays or provisions for this is they do it on a probability-based methodology. So what they'll do is they'll look at many different things, right? So first of all, they're going to calculate what we think that future balance is going to be. So they're going to calculate, okay, what's the current salaries of each of our employees? What are we expecting to increase their salary by? Is it 3% a year for the next 10 years, right? Then we calculate the number of staff, like are we going to change the number of staff? Are we going to lose certain staff? And that calculates the liability. Then what we'll do is we'll add on our on costs as well on top of that, because that's going to be paid out. And then we're going to basically look at the number of years that each of our staff have worked, right? This is the probability section. And because it's paid out in 10 years, it means that some people are going to have a higher probability than others of it being paid out. And also, there's less years, so there's less discounting. So what we'll do is we'll assign a probability and say, this person, because they've only got 1 year left until they get it, that's a 100% probability. Whereas this person who's only worked with us 1 year, we're going to say it's a 5% probability that they're going to get paid out, right? And then we'll also inflate the value of that, so we'll do our salary increases and then discount that value as well. So using our discounted cash flow rate to the current value. So anyway, back in that journals template file I showed you before, again, there's journals and notes in terms of how you can actually calculate this. So this will basically show you how to calculate your annual leave and your long service leave calculation, and then discount it based on future cash flow, and there's your journal expenses that you need to post in here as well. And probably the other just key takeaway is just the discounting of that based on present value, which I think you should be across that concept now. And then also accounting for share-based payments, which is IFRS 2. So basically a share-based payment transaction is where the entity receives goods or service from the supplier in exchange for shares, or it incurs an obligation to settle the transaction with the supplier in a share-based payment arrangement when another group receives those goods or services. So there's two types, right? There's the cash-settled share-based payment, which the entity acquires goods or services by incurring a liability to transfer cash or other assets, the amount of which is based on the price of the entity's equity instruments. E.g., an entity might agree to pay a cash bonus for employees' service of 100 times the company's share price, which might be a share-based transaction even though there's no exchange of the entity's equity instruments. It's still linked to the equity. Whereas in an equity share-based payment, the entity acquires goods or service as a consideration for its own equity instruments. For example, the company pays employees shares and executive stock options for their services. All right. So measurement of share-based payment transactions. So there's the equity settled approach or cash settled. So it really depends on what the company is actually doing. If it's equity, then you basically measure the goods or service received and the corresponding increase in equity at the end of the fair value of the goods or service received, provided that the fair value can be estimated reliably. In some cases, the fair value of goods or services cannot be estimated reliably. Under these circumstances, the fair value of the goods or services and the corresponding increase in equity are measured indirectly. Cash settled, on the other hand, is measure the goods or services received and the liability incurred at the fair value of the liability. Until the liability is settled, it may be remeasured at the end of the reporting period and upon settlement with changes in the fair value of the liability recognized in the P&L. In the case of equity settled share-based payment transactions, the fair value of goods or services acquired drives the measurement of equity, consistent with equity being the residual element in the statement of financial position. If the fair value of goods or services cannot be measured reliably, IFRS 2 departs from their approach and requires indirect measurement based on the fair value of instruments. So again, we can just refer to this template if you need to see the exact journals. I find this to be really helpful. All we need to do is just go to the contents and find share-based payments. Click on here. You can see the journals, and it's going to depend on whether it's a cash settled share-based transaction or an equity settled share-based transaction. Here's all the journals. We just basically calculate the liability, which is how much we're expected to pay. Again, it's probability based on the number of years it's vesting and the number of employees remaining. And that's in the example of, like an executive bonus, but it's paid in cash based on the share price of a company, which is usually the most common scenario. And this one here is an equity-based one. We're actually calculating the fair value at grant date as opposed to just the number of shares, and so forth. So just refer to that document for the exact journals. Moving on, so the next one that's going to be talked about in chapter 1 is investment properties. So this is basically any property held to earn rentals or capital appreciation rather than for the use of production or sale in the ordinary course of business. So IAS prescribes a mixed measurement model where the entity may either choose the fair value model or the cost model for all investment property. Now, as we mentioned before, there's going to be pros and cons with both methods in terms of which one's going to have a better faithful representation, which one's going to be the most relevant to users. So there's both pros and cons on both sides. So that's why there's some consistency in that measurement by allowing the preparer to choose between those models. So IAS 16 permits an entity to choose either the cost model or the revaluation model for PP&E after the asset's initial recognition. So where the revaluation model is the accounting policy, the increase in the asset's carrying amount is recognized in the OCI and is accumulated in equity. Okay, so basically for all of these, you can see the journals back in the same template as well. So similar approach, just go back to the main screen and then find the relevant topic in here. The journals will all be there. So because this requires professional judgment, the next subtopic within the notes is around professional judgment. Okay, and so financial reporting is focused on meeting the important objective of providing useful information for decision making, and this requires careful thought and professional judgment when deciding with how to deal with certain items. For example, which measurement approach are we going to take? And this often involves making a trade-off between relevance and faithful representation. So it really involves a combination of conceptual and practical knowledge. So the next we're just talking about, how do we actually approach where we've made a professional judgment in terms of the financial statements, and that comes down to disclosures. So entity needs to ensure that their financial reporting disclosures are clear and effective, and providing more information to users is not enough to meet users' needs, as disclosure overload is concerned for many users, usually especially as large amounts of information are available due to technological advancements, and also hiding some of the key information in disclosures makes it a little bit harder for companies to get away with things that they probably shouldn't. So here's some criteria for determining whether disclosure is actually required. So IAS 1, Presentation of Financial Statements, which we'll talk about in the next chapter, notes that compliance with IFRS with an additional disclosures when necessary is presumed to result in fair presentation, and an entity achieves fair presentation by compliance with applicable IFRSs. So a fair presentation also requires entities to select and apply accounting policies in accordance with IAS 8 accounting policies, changes in accounting estimates and errors. IAS 8 sets out the hierarchy of authoritative guidance that management considers in the absence of IFRS. And in Australia, the types of entities that are prohibited from such departures from a requirement in accounting standards are entities for which the Corporations Act applies, not-for-profit entities, entities for which reduced disclosure requirements apply. So basically, these entities have to follow IFRS very, very closely, whereas if you're a special purpose entity, as we talked about at the beginning of this video, they're exempt from doing it. They can do special purpose, just made specifically for their users. And now we're on to the next topic of presentation of financial statements. So we're actually going to be using a different source for the next video, one which I find probably illustrates it a little bit better than what's in these notes for this particular chapter, but then we'll jump back on the notes. So I might do that throughout these videos. I'll jump between the best source, I think, to get across the same message, but don't worry, the content is exactly the same. It's just about how it's presented. So I'll see you in the next video.